Over 13 years of asset management experience, he advises over $3 billion of equity investments in India alone. I caught up with Swanand Kelkar, the ED at Morgan Stanley Investment Management, and began by asking him about that one sector where he sees a safe 25 to 30% appreciation in the next 1 to 2 years.
I think it's fairly easy, right? I mean, here is an industry setup where 2/3 of the industry does not have growth as its top priority, which is the SOE banks, right? So there is 1/3 of the industry which has reasonably clean asset quality for most part, can focus on growth. So growth is not a challenge because 2/3 of the economy, 2/3 of the industry is not doing much. And if you have maintained asset quality thus far, right? You haven't had an asset quality problem thus far. I think it is reasonable to assume that you wouldn't have a big corporate asset quality problem creeping up in the next few months and quarters. So I think private sector banks seems to be reasonably good. Growth is reasonably good. ROEs, I mean, again, sticking back to our old template. Yeah. I think that would be a place where you are fine. I mean, bond yields will keep fluctuating. That will have a near-term impact on banks and what happens, etc. There will be collateral effects, knock-on, knock-downs. But that's fine. I mean, I think if you look through all those and you think about the next, maybe not 1 year, but maybe 2 to 3 years, I think private banks is still a good place to
You'll never go wrong there.
I never say never.
Well, yeah.
But the risk reward is still in your favor of having a decent compounder and still being able to sleep at night.
You take cues for investing a lot from this aspirational Indian. So what is this aspirational Indian telling you about your investments? Where is it that you need to tap into pockets?
So the aspirational consumption is something that we got in early. I mean, we have always preferred the consumer discretionary space versus consumer staples. And the good part about it is that we live this every day. I mean, if you just compare what you are spending money on 20 years ago versus today, it will tell you what stocks to own in the portfolio, right? I mean, I have watched movies in theaters where the acoustics were really bad. There was a lag between what the actor used to say on screen and what you used to hear in terms of the dialogue. You had rats for company. The food was really bad. I mean, that is gone. I mean, now you go into a multiplex, which is...
You want the popcorn, you want the Coke, the works.
Exactly. So that's changed, right? And you're not reading this in any consulting report. You are living this...
Yeah, you're experiencing
this
every day.
Right? So, and that's where you take your cues from. I mean,
but we're a minuscule part of the population, right?
Absolutely, absolutely. But this thing is now percolating to
penetrating to tier 2s and tier 3s too,
which I find very interesting. The other trend which I have picked up of late, I mean, just being around. I mean, I saw 2 hoardings on shops very close to my office. The first one said loan pay phone, which means that you can buy a phone with a loan. You can pay an EMI on the loan. And right next to it was a DSA of a company, and it said phone pay loan, which means that you can get a loan on a phone. You can get your credit score.
That easy to get.
You can get credit score appraised, and you can get a score. So loan pay phone pay loan, next to each other, I think is a trend that can go for the next 3-4 years, where the Indian household levers itself up. So the household leverage in India is very low. Household debt to GDP is fairly low, and there is, I think, there is a generational shift in attitude which is happening. My parents, very debt averse. Debt was a bad word. You cannot have debt. They bought all their assets, whatever meager assets they had in terms of the house, from their own savings and pooling from friends and family. I see the millennials in the family. I asked them
first taking the loan and then deciding what to do with
it. Absolutely. I think the generational shift in attitude is happening, which will show in the debt to GDP. So it's very simple, right? What do you buy? You buy people who are giving them loans and doing it sensibly, and you look for what these people are buying. They are buying phones, they are buying cars, they are buying bikes, they are buying discretionary items like accessories, fashion, etc. So both those are great pools to think of. I mean, think about people just doing it sensibly. And you know what to have in the portfolio.
The other leg then, CVs, I recall, is something that you were extremely bullish on. Hopefully it should be a good monsoon for a 3rd year consecutive. Opportunities still, or has one missed the bus already?
No, I think the CV cycle we have played for the past 3-4 years. It's a deeply cyclical sector. But again, what we have done is a bit counterintuitive. We have sat through the past 3-4 years in certain CV stocks that we own. So the cycle was in one way. So some of the private sector banks are what I call clockwork compounders, right? Every quarter, tuck, they give the same numbers. These I think are also compounders, but they are compounders over 3-4 years of time, but go through a cycle within those 3-4 years, right? And CVs we have stuck through. I think it still has steam. I mean, if you look at the volume numbers coming out on a monthly basis, it's doing really well.
Yeah.
If the economy is picking up, which it seems to be, I think CVs will do well. It's a derivative play on the economy, especially the heavy side, the mining and things like that. I think commercial vehicles will keep doing well. And in India, it's still pretty much a duopoly. So you don't get those industry characteristics in a lot of places, right? The Indian autos, I think it's very interesting where you have a consumer car company with a market share in excess of 50%. It's only Korea is the only other market where a car company has more market share, which is Hyundai and Kia put together. I think that kind of an industry character is very difficult to find in any other country.
It's a different dynamic altogether.
Exactly. So the one is the CV cycle, which you take a call on, and I think it still has legs to run. But the other is also how it plays into the industry dynamic. I mean, if had this been happening with a 20-player market, I'm sure all 20 of them would have killed each other with discounting, right, and had 5% EBITDA margins. But that's not happening, right? I mean, there is enough level of sanity out there, especially in the passenger vehicles space.
And clearly only one dominant leader.
One dominant leader, which is...
you got to bow down.